Hello, hello, hello. What's going on, everybody? Can you guys hear me loud and clear in the YouTube audience? You should be able to see gold on the screen here, just the black chart, 4-hour chart, and the normal capital hungry layout. Okay, everything is good. Welcome to a Capital Hungry Monday Market Update and Trade Ideas webinar. Now, of course, we like to do our fundamental and technical analysis, but we also have to bring together key concepts of market psychology as well as personal psychology and interconnect those concepts into our analysis. Because it's very easy to understand that you could be looking for buys and sells at a current price point, but if you're not adapting to the current market conditions at play, execution can still be an issue, as well as overall risk management, trade management, and so forth, right? So I want to go over some key points as we start out this webinar in terms of current fundamentals that are impacting the market and how it's, of course, impacting current conditions up until we have a lot of rate decisions in focus, and how we have to adapt from a psychological standpoint as manual retail traders. So first things first. Overall, the main driving factor of financial markets over the last year and a half has, of course, been the Federal Reserve rate hike cycle and central bank sentiment from other main central banks around the world, such as Bank of Canada, Bank of England, Euro Central Bank, and so forth. The main reason why dollar has been so bullish over the last year and a half, why crypto, real estate, equities, oil, and gold have been a lot more bearish, is because of the market adjusting accordingly to the cartel of the currency, the Federal Reserve, actively increasing interest rates and stopping the support of the economy through pumping of the markets and printing of money. This is the main fundamental information advantage and the main driving factor of how the algorithms from an institutional standpoint have been adjusting order flow. This is the reason for dollar domination, gold bears, stock market bears, pairs like GBPUSD and EURUSD being so bearish. That is the main reason. Now, as we're approaching the Federal Reserve interest rate decision midweek on Wednesday, we can see a lot of this sentiment so far has been priced in. So as a lot of the main fundamental information has been priced in, as we're starting out the new week with some bank holidays from the UK, from Japan, and so forth, and as a lot of the market liquidity is more sitting on the sidelines until we have the interest rate decision confirmed midweek, we can see that current conditions are showing us consolidating markets, ranging markets, and overall slower volume and volatility. So we have to adapt to these conditions accordingly, and I'm overall expecting less volume and volatility until after the Jerome Powell Federal Reserve interest rate day, where we're going to get confirmed if the Feds are still continuing their hawkish approach or starting to turn a little bit more dovish if recession fears are continuing to develop. Okay? So, let's understand some main things. The main driving factor of overall order flow so far has been priced in. We're seeing slower volume and volatility in more ranging markets, which makes sense as markets and investors and smart money are waiting for the central bank statements, with the Federal Reserve being mainly in focus. We have Bank of England rate decision this week and Bank of Japan as well, right? There's a high probability markets may range until this Fed rate decision, as we have minimal economic data up until there as well, okay? Now, my main higher time frame fundamental bias is still overall expecting US dollar upside, gold bears, stock market bears, and other asset class bears. I'm still expecting the Feds to be relatively hawkish. If the Feds do a 75 to 100 basis point rate hike and still continue their same sentiment approach, then I'm personally expecting dollar domination to still continue, stock market bears to continue, gold bears back into the 1650 lows and potentially lower, and continuing our higher time frame bias. The Feds would need to be very dovish, and that would only be playing a game called the balancing act by the Feds to minimize market impact if they only do a 50 basis point rate hike where if they only do a 50 basis point rate hike, then there's a higher probability stock markets will be bullish, gold will be bullish, and dollar will be bearish in the short term. But nonetheless, the higher time frame sentiment is still in play. What I mean by that is higher time frame, gold is still extremely bearish across the board due to the Federal Reserve rate hike cycle holding the most weight. Very clean breaks below the 1800s that we called here. Very clean breaks of 1680s demand zone. Just as we're having sellers print new consecutive lower lows into the 1660s, we're showing a little bit of double bottom and potential exhaustion, which can really just be price setups for FOMC, where even if we dig into the 1700s, retesting previous significant lows, and we have a priced in FOMC just giving us a little bit of a pullback phase, this would all still be relatively bearish on gold. Yes, in the short term, if we get a short-term dovish FOMC, short-term bulls on gold, we can take advantage of these pullbacks like we have many, many times before in these short-term pullback phases that occur. But overall, our main higher time frame expectations are at the 1700s or even the 1720s, still looking to jump back into higher time frame sells, continuing the macro bias of dollar domination, more Fed rate hikes to come, and the Fed focus from a macro perspective being on combating inflation and revisiting the 1660s again there. Does that make sense for everybody? Even, for example, when you're coming here and looking at the dollar. Dollar is extremely bullish on its higher time frames. We're just seeing a little bit of consolidation and indecision on the intraday time frames at higher time frame highs here, right? So you can see dollar is just consolidating at these highs, still extremely bullish. Even if we get a priced in dovish FOMC, I would expect dollar to have a short-term downside move to double bottom at 108 and still continue bullish in the higher time frames going into October. Or if the Feds just give us a straight hawkish sentiment and do a 75 to 100 basis point hike, still talk about more rate hikes to come and keeping rates high for an extended period of time, still give us the sentiment that their primary focus is bringing down inflation, then we're just going to have dollar break out above 110 and just continue bullish, right? So basically, this is what I'm trying to explain. As we're going into FOMC and potentially with FOMC, a short-term bearish move on the dollar would be a dovish FOMC, which would of course just be giving a short-term downside on the dollar if they only do a 50 basis point hike, or if they're keeping their statement relatively neutral, which would give a short-term downside on the dollar. But if we don't break back below previous highs and demand zone at 108, that move would get faded out with higher time frame buyers coming back into the scene the next week or going into the next month of October. Or, which means we'd have to adapt to a short-term downside pullback phase before jumping back into the higher time frame bullish bias. This would also lead to that correlated factor of gold just having a deeper pullback phase into the 1700s and 1720s before continuing bearish on the higher time frames again. What would be easiest is if the Feds during their interest rate decision just come with the straight hawkish sentiment, dollar maybe just ranges up until Wednesday, doing maybe a deeper pullback phase, and then Feds come in with an aggressive rate hike. This isn't a fake bullish dollar. It's a real bullish dollar. I don't know what the fuck a fake bullish dollar means. But if the Feds come with the 75 to 100 basis point rate hike, very hawkish statement in speech, and of course talk about continuing to combat inflation, we're just going to have dollar upside continue, and that would be the easiest play, with gold just probably rejecting maybe 1700 lows here and then turning bearish again on the higher time frames. But regardless, right now it's only Monday. Right now we can see dollar having a consolidation and exhausting at these previous intraday highs, right? Gold we can also see consolidating at these intraday lows with just a double bottom being created with potential for deeper pullback phases on the intraday time frames to set up better price points of interest for FOMC sells. Demo traders talking about birds while analyzing trades. We're not talking about birds. We're talking about the central bank sentiment. And I'm not demo. I've proven my live account for 4 years now. You don't even know what dovish means. This guy thinks we're talking about real birds when we're talking about hawks and doves. What a dumb motherfucker, eh? We're talking about the central bank, the cartel of the currency, the one who dictates the money supply, interest rates. This is economic terminology. Dovish, hawkish. We're not talking about actual birds, you fucking retard. This isn't National Geographic. We're not talking about real hawks and doves. Some of you guys are crazy. Alright? So anyways, in the short term, there's a high probability that up until the interest rate decision, we're more than likely going to range and consolidate and have price setups as we have a lot of the market liquidity on the sidelines with the institutions and smart money primarily waiting for the Fed interest rate sentiment and other central banks such as Bank of England and Bank of Japan as well. This is a very high reason why GJ has been ranging and having aggressive corrections. This is the reason why gold, just to start off the new week, is ranging at intraday lows. This is another reason why GBPUSD, just to start off the new week, is ranging. This is the reason why EURUSD is in an intraday consolidation in range at higher time frame lows. And this is also why US 30 equity markets are ranging at previous intraday lows as well. Okay? So again, just for the retards in the back, the main driving factor of the market so far has been priced in. We've had some holidays to start the week. We have a lot of the main fundamental information midweek. There's a high probability we're going to see ranging or consolidating pullback markets up until price setups at the actual FOMC and so forth. Okay? From a psychology perspective, we have to adapt to the market waves accordingly. We have to understand when you have ranging and intraday moves that the price action can be a lot more choppy, a lot more aggressive, very hard to potentially trade manage on as well. So you have to stay adaptive to this. Don't burn your capital, don't burn your mental energy, and don't just waste all your focus playing ranging markets. Do your analysis, have your pre-planned trade ideas, but primarily wait for the sentiment after interest rate decision, because you're going to have way cleaner volume and volatility, and you're going to have the sentiment set in place by the cartel of the currency, the Feds. Once the Feds give their cold, hard statement at the interest rate decision, whether they're going to continue to be very hawkish and continue to keep interest rates hiked, which will lead to dollar strength, then you're going to have easy gold sells, easy stock market sells, easy continued dollar buyer bias. But if the Feds have a short-term dovish statement, we're just going to have deeper pullback phases before we continue our higher time frame bias. Right? So because of this, we can see that volume and volatility to start off this new week is a lot slower and more stagnant. So we have to stay adaptive to these conditions. In terms of market sentiment, US dollar is still bullish on the higher time frames. Japanese yen is still bearish as the Bank of Japan has been keeping interest rates in the negative, keeping their unlimited bond buying program going. And because of how Japan's economic structure is set up, they've been actually trying to accelerate inflation. So higher stimulus, continued money printing, interest rates in the negative, unlimited bond buying program. Japanese yen is still bearish on the higher time frames individually, just having some ranging at its lows. Equity markets, in terms of the US equity markets, are still bearish as well, as you're having the main driving factor of central bank interest rate hikes holding the most weight and making conditions less favorable for stock market buyers to keep pooling into stock market buys. Higher interest rates, less stimulus, inflation being combated, dollar domination, and so forth. Right? So dollar still extremely bullish, just ranging at its intraday highs. Even if we have a short-term pullback phase to 108, would still be very bullish. Easiest plays would be the breakouts above 110, breakout above the consolidation, continuing to play those buys. When you're looking at the Japanese yen individually, still extremely bearish in intraday and higher time frame structure. Again, as market volume and volatility is lower, we had a Japan holiday to start the week. We're just ranging at intraday lows. Global equity markets are still relatively slumped over and bearish across the board, as interest rate hike fears is what's dominating smart money order flow, and you're seeing way less buy side liquidity entering the market, and a bear market more active, where you only have short bear market rallies that get faded out and continue downside in equities. Okay? Now, before we jump into our technical and fundamental analysis of trade ideas for the next coming sessions, we just have to stay adaptive to conditions and understand what economic events we have on the topic, on the docket here, right? So obviously, the main focus points are midweek, later in the week, with Federal Reserve interest rate decision, Bank of England rate decision, and Bank of Japan rate decision. High probability we're going to be ranging and seeing shittier conditions until then. But if you're still looking to take some scalps in intraday trades, these are going to be my suggestions that follow, understanding what economic events we have, as well as current technicals and order flow understanding. Okay? 2 a.m. Eastern, pre-London hours, we have some producer prices data for Germany. Won't have that much impact. 8 a.m. Eastern, 8:30 a.m. Eastern, we have housing data for the US. Expected to be decreasing, won't hold that much impact, may keep gold a little bit more bullish in the short term. Then at 8:30 a.m. Eastern, we have inflation figures for the Bank of Canada reporting core CPI for CAD, and then the overall CPI, inflation monthly and yearly core price index for CAD here as well. Honestly, won't have that much impact. Might give the Canadian dollar a little bit of strength, giving UCAD a pullback from highs. And then the Treasury auctions are normal information that we already have that we already see day to day. Won't hold too much impact. Not much on the docket overall. Still expecting slower and lower volume and volatility until midweek. We do want to keep in mind some of the Philadelphia Business Outlook survey report at 8:30 a.m. Eastern impacting the US dollar. Fed interest rate decision is of course on the 21st, but we want to keep an eye as it's a 2-day meeting on interest rates, so we might have some Fed speakers scattered out throughout the day tomorrow as well to keep an eye on, and just some central bank speakers that are scattered throughout the day tomorrow. Okay? That's just the worst comment I've ever seen. That's just a very NPC type of comment. This guy said, I'd rather follow people that do a lavish lifestyle and post a lot of lavish stuff than follow people giving information and value. I don't use FTMO. I trade my own money. So I don't know where you guys get these claims from. Now, anyways, let's look at gold here. Gold, we can see that we've had a very, very significant break below 1680's higher time frame monthly demand zone, and also below this intraday 1700 support area. So we're sitting on a key level where we're creating a technical double bottom here. Now, the technical double bottom, right, isn't something that's just like a pattern and you start to buy. It's information about order flow. What it's showing me is that as we broke below this sell side liquidity zone after having a deeper pullback phase from the 1690s up into the 1730s, we had enough sell side liquidity where we finally had an accumulation of order flow on the intraday time frames and a very strong impulsive break to the downside, right? Sellers drive us down into the 1660s. To start off this week, we had a pullback to the 1680s key level and enough liquidity generated from that area to drive us into these same lows but fail to break lower. This shows me that there's not enough fundamental reasoning or information advantage for more sell side liquidity to enter the market here, which gets printed as this technical double bottom. It shows me a lot more sellers exiting positions and buy side liquidity generated from the 1660 lows, as we're having potential price setups for FOMC. Now, if we can break above 1680s in the short term, I can easily see deeper pullback buy plays into the 1700s and even into the 1720s, setting up price for potentially FOMC. Otherwise, safer sells at this point would be back below the 1660s, breaking these lows and validating enough sell side liquidity to trade lower, expecting new lows to be printed, right? Does that make sense for everybody so far in terms of understanding the order flow, right? Keep in mind, lower volume and volatility, a lot of the fundamentals so far priced in, the exhaustion at the 1660 lows, price setups for FOMC, dollar short-term consolidating as well. Now let's bring this information together to the table here with some of our higher time frame key levels and expectations of data. Now, when I'm looking at gold on the intraday time frames, right, I can see very significant sell side liquidity zones where we had accumulation of order flow before continuing down, right? Obviously, you had your consolidation here, you had a consolidation here, and you had a revisitation of 1680s here. We had liquidity generated and accumulated of seller order flow and a drive down from this price sensitivity area into 1688s, another accumulation of seller order flow and an impulsive move into the lows at 1657 key level, roughly 1655 lows. What we can understand based on order flow is even as we had a pullback to 1680s, we had enough sell side liquidity to revisit these lows but fail to break lower. So we're seeing exhaustion by sellers at these lows with this bit of a support being created, which is showing us sellers exiting positions and higher probability of a deeper pullback phase. But I can't expect a deeper pullback phase unless we're trading well above the 1680s. Then I can see some of these higher time frame sell side liquidity zones getting retested before potentially continuing bearish again on the higher time frames. So bringing that information together to the table, if we break above the 1680s monthly support level and higher time frame key level in the short term, fading out this sell side move to the downside here, then I can see deeper pullback. Then I can see deeper pullback potential buys up to retest better sells in these price points stated here, marked in red. Retesting this potential sell side liquidity zone at the 1692, and of course digging into 1705, 1700s area here, right? So I can only see short-term pullback buys on gold, which would really be setting up better sells on the higher time frame for potentially FOMC if we break above 1680s here. If we have lower time frame break and retest above 1680s, failures to break below 1670s here as well, then I can see short-term buys that you can take advantage of, right? Otherwise, if we just have a rejection at 1680s or range here, if we break back below 1670s and break back below the lows and don't break 1680s, we're just jumping back into the higher time frame sell side buys. Okay? So breakout above the green box, understanding that order flow and potential price setups will be short-term buy plays to set up into better sell zones on the higher time frame. Otherwise, if we just consolidate and fail to break higher, sells back below 1670 and back below 1657 key level. Does that make sense to everybody? Let me show you an example of this, right? Let me zoom out and show you an example of this. For the example, right? Let's look at something like this. This is a very significant downside move that was previously seen before, right? Same fundamental reason why gold was bearish, Federal Reserve rate hikes at that time. At that time, you had sellers drive down after generating significant liquidity from the 1900s all the way to the 1800 lows, right? But you can see in this general area, as you start to show signs of exhaustion, and if you break above that last key rejection point, it's not out of the ordinary that gold enters a deeper pullback in corrective phase, where this pullback phase went all the way back into 1880s before still continuing the higher time frame trend bearish again. Right? You can identify the exhaustion at the lows, you can identify a break above that key rejection point, and you can take advantage of some of those pullback squeezes in the short term, all the way until you're jumping back into the higher time frame sell side bias again, and then you just continue with your higher time frame trend back into the bears. Right? You understand what I'm saying? So right now, when we're looking at gold, we have had, ever since this pullback in liquidity generated in the 1800s, we've really had very consistent, smooth, and steady downside all the way into the 1660s. When you're looking at some of your key price points of interest to the left, you can see that drags right across the board to, of course, the 1680s here, right? If we can identify the exhaustion at these lows in the short term, potential price setups for FOMC, and we break back above that level, gold can easily have some deeper pullback phases on the higher time frame before still continuing bearish overall into the potential next month. Does that make sense for everybody or no? This is going to be a similar type of ideology and setup on GBPUSD, EURUSD, and even the US 30 equity markets, because the main driving factor has of course been Federal Reserve interest rates, how that sentiment gets priced in, and then it's very common, as gold has been making its way to the downside overall here ever since really the start of the year, and we've been playing it since April, it's very common to get these aggressive pullback phases that occur. These pullback phases don't break overall bearish market structure. They don't change any of the sequence of events. And whether the pullback phase is long in terms of periods like this, or whether it's very short pullback phases like shown in pink here, as you're making your overall way to the downside, we have to adapt to these pullback phases accordingly. And what I can identify on gold here is if on the intraday time frames we're breaking above the 1680s, we can easily have a pullback phase to set up better sells on the higher time frame before still continuing down bearish again. Right? Is that not easy to understand? We currently have dollar consolidating, equity markets having a little bit of a bounce. We have prices setting up for FOMC. We have some short-term exhaustion by buyers and double bottom at these 1660 lows. If we see a pullback phase occur for the next potential week or couple of weeks, it won't be out of the ordinary, and then October be jumping right back into the sells again. Now this pullback phase, it can be over the next couple of days and even into FOMC if FOMC is a dovish neutral sentiment. In the short term, this will give, in terms of market psychology, stock market buyers a bit of relief and a short-term bear market rally on stocks, which would just be trapping more buy-side liquidity in stocks on the higher time frame before still continuing bearish, as Feds in the long term still have to keep interest rates up, and there's still going to be more rate hikes to come and more economic data to digest in the coming weeks after that into the new month of October. Now, what would be the easiest is if the Feds, we just have a short-lived price setup, maybe just retest these lows at the 1700s, and the Feds are hawkish, and we just start to melt and continue bearish, smash the 1660s. That would be the easiest setup for us. But that's not always going to be the case. We have to have realistic expectations of a potential pullback phase that can occur. So that's why when I'm looking at gold and reviewing that again, if we break above the 1680s, I can see those short-term pullback phases to potentially better sell zones where I'd be looking at into the high 1690s here and into the 1700s, 1705s. Otherwise, safer sells from current price point would be back below 1670, back below 1657. And remember, we're just staying adaptive to the conditions of if we identify that pullback phase taking place, we can take advantage of it in the short term and then jump back into the sells with potential FOMC hawkish tone. Right? Now, you're going to see this similar type of understanding when you're looking at and zooming at on GU. The reason why dollar pairs with the dollar as a secondary in the pair has been so bearish overall on the higher time frames is the Federal Reserve rate hike cycle. The Federal Reserve, in terms of being the cartel of the currency with the US dollar, the US dollar is pegged as the global reserve currency, the business currency. So it holds a lot more weight in terms of its value whenever you're having it against any other currency when you're looking at currency pairs, right? Even with the Bank of England hiking rates, that only gives short-term bounces on GU, which ends up getting faded out on the higher time frame, continuing the main bias and sentiment. Now, when we're looking at GU, we can see we've had significant lows printed and a little bit of a double bottom. This is just initial signs of exhaustion. I would need to see GU trading back above these previous significant lows that were printed here. From these lows, we had a deeper pullback phase, more sell-side liquidity generated from 1.17 flat that led into newer lows being printed. I can't anticipate any deeper pullback phase on GU unless we're trading above there. Then in the short term, we may see some price setups going up into better sell areas for FOMC or even post FOMC, right? So right now across the board, when you're looking at gold, you're having consolidation, pullback from lows. EURUSD consolidating at lows, waiting for the price setups and sentiment of Fed interest rate. GU consolidating at lows, right? US 30 having a pullback and consolidating at these previous higher time frame lows on the equity markets. Dollar consolidating at its intraday highs in a range on the intraday time frames here. You can see that's been doing since last week, right? So we're going to see a similar pattern across the board. Bringing that information together on GU. Okay? If we just have a failure to break above and we start to flip back bearish again, continued sells below these lows, especially with the correlation factor if equities turn back bearish and dollar breaks above its consolidation zone. Otherwise, we do take live trades every single day during the live scalping session. I've shown my live trades for years now. You know what I mean? This is just an analysis and educational webinar. Prep for people. You're not going to have live trades available at 5:30 p.m. Eastern. If you go to this YouTube channel, there's hundreds of webinars during London live scalping sessions and New York that I've done over the years. You're not on my level of market understanding, right? If people don't study the markets and put effort in learning, they're never going to find success. They're always going to be trying to chase every trade, scalping 100 times a day, over trading, over leveraging, having no clue what's going on in the markets, constantly burning accounts. Analysis and understanding isn't easy. Understanding fundamentals, technicals, back testing, understanding market direction is not easy. And especially for retards like you who make those comments. Trust me. Motherfuckers like you are stupid as hell. You know what I mean? This guy said, let me get a number 5 with rice to him. Ruthless. But anyways, if we just have dollar strength come back into the table and we're trading below the key level in previous lows, just continue the sell side bias. But in the short term, if we break back above previous significant lows and level 1.146, I can see short-term buy plays to retest better sell zones on the higher time frame. Okay? So on the intraday time frames, if the new daily candle just makes a lower wick, we start breaking above these rejection points in previous lows in medium-term zone 1.145, then I would see short-term buys with the correlation factor of dollar being a bit more bearish, stock market having a relief rally, and so forth as well. Okay? Same type of idea when you're coming here and looking at EURUSD. If we just come back below this range, break below the key level and lows, just continue the easy sells. Otherwise, we can easily see short-term pullback phase buys to retest better sell zones for FOMC, which the buy plays would be above 1.005. And better sells at the double top and sell side liquidity zone around 1.02 potential FOMC setup. I'm trying to give you guys information on how to adapt from a psychological standpoint, how to do analysis, adapt to market waves, fundamentals that are coming up, what to expect with potentially FOMC, market timing, and understanding the end of the month period as well, right? I give you guys a lot of free, valuable information that I've learned over 6 years now, with proof that I'm a successful, consistent trader as well, from penny lots to where I am now. A lot of people take this information for granted or ignore it because they don't understand the words, they don't understand the concepts being used, and they're scared to learn. They're too intimidated to learn. So I highly suggest people watch these webinars 2 or 3 times, because I'm going to be teaching you a lot that's more than just trade ideas and so forth, right? Don't worry, GJ will get to it as well. You don't have to, we're going in order here, and our dollar pairs first. Now, USDCAD, I'm still in a bullish bias, but I'd be looking for pullbacks to the key level and pullbacks to 305 buys or continued buys above 1.311 highs. Trust me, some of you guys will be paying mentors $1,600, $1,000, paying them hundreds of dollars a month, and they won't even be giving you the information I'm giving you here for free. They don't know anything about central banks. They don't know anything about interest rates. They don't know nothing about investor psychology or market sentiment. They don't know anything about adapting to market waves. They don't know how to give efficient trade ideas or analysis. People are paying for Fibonacci, cookie cutter support and resistance, indicators like EMAs, paying for signals that lose every single time. So trust me, don't take it for granted, because one day I might not give a shit to do this anymore. You know what I mean? Get very bored. US 30. Now, similar idea here, right? We can see a very similar pattern across the board. Doesn't matter if it's dollar pairs. Doesn't matter if it's a precious metal like gold. Doesn't matter if it's equity markets like the US stock market index Dow Jones here. We can see as sellers have printed new intraday lows, and we're driving into very specific price points of interest on the higher time frame here, being the last significant higher time frame lows roughly at 3,400, right? That we're also getting a similar sequence of events of a potential double bottom that's occurring, just showing some more sellers exhaustion. Yet you can't show 1K profits? This guy doesn't know me at all, eh? Who's this extra BBQ sauce? Are you serious? Just go to my Twitter or Telegram. I show trades and results from the weekly, monthly, quarterly, all the time. 1K profits. Sure about that, my guy? Forex Factory is not going to teach you fundamentals. Forex Factory just delivers data. You know what I mean? Yeah, you guys can see all my trading proof, all my results. You can see it on Twitter. You can see it on Telegram. You can see it on Instagram, showing my live account proof, equity curve, live account on the actual website, the trades taken, the results after a month and 3 month and year, It's all there, you know what I mean? Anyways, let's go back to US 30. So as I was describing, the majority of asset classes that have been so bearish and primarily been bearish on Fed rate hike cycles, all are starting to see some exhaustion at previous lows here, or significant price points. We're getting this double bottom that's occurring. Where a similar idea, if we can see us holding above previous lows, dollar short-term bearish, as well as volatility index relatively bearish, if we break above 31,200, we can easily see some short-term buy plays setting up for FOMC until jumping back into sells. Right? I didn't block anybody. You guys are all here talking. You know what I mean? These have to be Anthony's students, or this is probably Anthony's world. The retard 1,000-lot fucking demo Miami mans, lifestyle marketers. You know what I mean? You guys are going crazy out here. So, when we're bringing that information together to the table here, and you're looking at US 30 on the intraday time frames, I would look for short-term buys on the stock market above 31,200, potentially leading to better sell zones at 32K flat and 32,300. Otherwise, continued sells if we're trading below 31K flat and, of course, 3,500. Listen, I love trolls. You guys, I love trolls. I don't block anybody. Keep typing. Keep my chat rate up. Keep watching the stream and giving me your minutes and attention. Keep it up. It's okay. I don't mind. I'm the one who has the fundamental and economic understanding. I'm the one who's doing these webinars for free. I'm the one who's shown trading results for 4 years. I'm the one who knows exactly what's going on in the markets and why. If you want to come give me a free view and troll and keep typing, all that's good for me. You know what I mean? I don't mind. Keep typing away. All of that is more interaction. You think the AI algos know if you're sending a hate message or typing and sending a normal message? They don't give a shit. This is all numbers, baby. I only give a fuck about numbers, baby. You think I care about feelings? Keep typing. It's all good. We don't mind. We love the trolls. We do not mind. But anyways, short-term pullback phases on the equity market. If we can break above this consolidation, previous lows, VIX short-term bearish, dollar short-term bearish, and we break above 31,200. Right? Otherwise, continued sells below 31K, 3,500. This is short-term pullback phases. It's just funny. You guys have to have a little laugh too. And I don't care. After this webinar is done, I'm going to go about my day. You know what I mean? I'm going to go eat some food, go to the gym later. It doesn't matter to me. It's just fun. All this shit is fun for me. I like doing these webinars. I like interacting with the people in the internet. I like sharing fundamental technical information, psychology, and so forth. You know what I mean? I have a free Telegram group. I have a free Telegram group with 7,800 subscribers in it. You guys don't do any effort. You guys don't go check out anything. You guys don't check out anything. You know what I mean? No. I'm just gonna flash that there real quick. Get off my dick, yo. Get off my dick. But anyways, what was the last pair? We went over gold. We went over GJ. Now, GJ overall has been in a pullback phase from its intraday highs. This is Anthony's world in the Miami guys, trust me. They're mad that I called them out because they can't do anything except show Lambos and shit. So they're just mad. GJ on the higher time frames is still extremely bullish. We've just had some exhaustion and failure to break these highs. But what I do like is this demand zone that's been respected, as well as this accumulation of buy-side liquidity in this area, and a very nice bullish breakout where if we get continued hawkish remarks from the Bank of England, as well as dovish remarks from the Bank of Japan, continued rate hikes from the Bank of England, if we're not trading back below that consolidation zone and accumulation of buy-side liquidity, we have a lot of potential to continue bullish again, right? When we're looking at GJ now, you can see we're in this pullback and corrective structure. When we're bringing that information together to the table, Japanese yen is still bearish at these intraday lows. We have expectations of more rate hikes by the Bank of England and the Bank of Japan still being relatively dovish. And if GJ continues to hold above 163, we can see buyers coming back into play here. If we get pullbacks and retests of 163.2 and fail to break, that would be high risk, high reward buys. I'd be looking for the buys above 163.8 and 164. I'm not encouraging anybody. They're just on your ass because you're a retard. You have low IQ, you're addicted to TikTok, you're addicted to social media, you don't know how to go study anything, you don't know how to go do your research and check for results, you don't know how to go check up all the free shit I've done for years. So people are chirping you in the chat because you're a retard. Nobody's encouraging anything, you're just a retard. You guys are getting chirped hard. You guys are getting roasted, and all it's doing is bringing my interaction up. You know what I mean? Think about it. You're taking your precious time in life and your precious effort, and you're coming to my stream to talk about me, to look at me, to watch me. You're invested in me. You're invested into me. So you're invested into me more than you're invested in yourself. You know what I mean? Get your life together, my friend. I own you. I'm your daddy. You know what I mean? Call me Papa. Call me Papa now. Call me Papa Jeeve in the chat. Because you're just watching me, looking up to me, texting me, messaging in my chat. Look up to me. Call me Papa Jeeve now. Alright? Thanks for the interaction. Thanks for the messages. Thanks for the attention. Thanks for all of that. Alright? So I'm your papa there, Chinese man with the Chinese writing. I'm your papa to the other guy. I'm your daddy. But yeah, GJ, I would only see any further sells below 162.2 or 162.5. Otherwise, if we have a consolidation, breakout above the corrective structure, yen still bearish, and of course, see more Bank of England rate hikes, we'll have GJ buyers coming back into the scene. Whew! Anyways, everybody, great webinar. So great webinar. I highly advise everybody to rewatch this, right? So we went through key fundamental points in focus right now and how it's impacting the market. This guy said he's gonna come join and pay for me now. So now the hater troll is gonna come pay me as well. Wow, what? Hey, you're really smart up here, eh? You got a big IQ, bro. So anyways, we went through key fundamental points and focus points of what we're focusing on this week, right? How that's going to impact our psychology and how we have to adapt accordingly. We understood and went through a quick volume and volatility reading. We went through understanding market sentiment impact and analysis on dollar, yen, and equities as well. We went through what economic events we have on the table overnight, as well as political events in focus. Then we did some individual technical and fundamental analysis on gold, GU, EURUSD, USDCAD, and US30, lining up some trade ideas on the intraday timeframes, for potential scalps or day trades. All right? You guys can rewatch this as you wish. Yeah, that guy's a big fan. He just went from hating and talking shit to saying, I'm going to join Capital Hungry. I'm going to pay for you. Okay. What the hell? If you come to the Capital Hungry YouTube page, right? If you scroll down here, I don't know if it's even going to show it. Look. All of this, there's no lifestyle marketing. There's no vlogs. There's no showing off the cars. There's no showing off of my house. There's no showing any vacations. All of this is free information from webinars that are hours long to short webinars on fundamentals, economics, market psychology, personal psychology, self-development, and more, right? All of this is more than any Q banks, any Miami mentor that you'll pay for. They can't give you this even if you are paying them, because you know why? They don't have the knowledge in the brain to give you this. The reason why I can do so much for free and also still have a market research group where people pay for my time and information is because of how much information's up here. How much knowledge, how much studying of the markets, focusing on macroeconomics, focusing on market psychology, understanding market waves and economic cycle. That's all here. You guys can go learn. Go for it. It's all there. Look at all this. There's 6 webinars in each row. And you have what? 50 rows of webinars here? Do the math. Who's giving you that for free? You have webinars on top-down analysis, on fundamentals, on higher time frame, on psychology, educational webinars on the dollar, how fundamental catalysts in gold, higher time frame technicals, short webinars, market updates, live trading streams, scalping sessions. Do I need to go on? Do I need to continue on? This is why I get so much hate, because I don't flash any lifestyle. I don't show any Lambos. I don't show any cars. I don't show what my house looks like. I don't show, oh wait, I'm wearing a $30,000 gold chain. I don't show that stuff because I don't need to. I'm here to go against the grain, avoid lifestyle marketing, avoid trying to cater to the pleasure model of people's brain, selling them shitty signals, selling them the same cookie cutter Fibonacci courses, selling them shitty algorithms that never work or find success, selling them all these shitty courses and packages. I'm going against that. Capital Hungry private channel is a different level. That's for high IQ individuals. But what I've done for free for the community for over 4 years right now cannot be matched. It can't be matched. I hope you understand that. It can't be matched. It's too much, and it's not going to stop. I'm still going. Right? All of my trades are shown on Instagram, Twitter, Telegram, from penny lots to where I am now, live account proof, execution points, wins and losses, results over months or weeks. You know what I mean? So that's all it is. There's tons that you can learn from. So much. It's crazy. It's so crazy. It's so crazy. All right? So make sure all of you, as people who enjoy learning about the markets or people that want to find success in the markets, make sure you use all these resources to your advantage. Tons of information to learn from. You can see how I've been doing analysis for over the last year and a half, how trade ideas have been playing out, analysis has been right, and you can learn from it. You can learn from it. I've even divided playlists for you. You can just go to the Capital Hungry page, click playlists. All the live streams are sorted, all of the market updates are sorted, all the individual webinars are sorted, all the educational content sorted. It's there. Value can't be denied. Mental fortitude can't be denied. Knowledge can't be denied. But when you look at all the marketers and when you look at all the gurus, when you get rid of all of their Lambos, when you get rid of all the lifestyle marketing, when you remove all the smokescreen, they're nothing. They got nothing. You know what I mean? So yeah, Everybody continue to put in that work, continue to hustle hard, continue to work as hard as you can, doing more. Because remember, whether you like me or not, whether you like my personality, whether you think I'm an asshole, I'm trying to help the people in the community, right? And you have to understand that whether I'm here or not, 90% of traders fail every single day. 90% lose. That's a guaranteed statistic based on human psychology and human nature. That's not going to ever change. You understand what I'm saying? I don't want to live in a cesspool like Miami. Why the fuck would I want to live in Miami where people are living a fake lifestyle? Everybody's trying to live a fake inflated lifestyle, trying to live up to an image. I'm happy. I'm financially well off, very good in my trading. I'm good with my businesses. My family's covered. I'm good. I'm very fit and in shape. Why the fuck would I want to go to Miami? You know what I mean? But anyways, Anthony's World, Q Banks, and all you goons that are watching, you'll never be able to compare to me. You'll never be able to relate to me. You can't. You don't have any knowledge in your brain. Alright? So everybody else who's enjoying the content, continue to follow the webinars, continue to learn as much as you can. Tons of free value shared. No lifestyle marketing, no stupid vlogs, no stupid showing off of random shit just to manipulate you. Only value, only information. Like, subscribe. Everybody take care. I'll see you all next time.